Good morning. This is Dylan Jovine with Behind the Markets. Happy Wednesday. Today is Wednesday, July 30th, and we are making it through the month. And today is also National Father-in-Law Day. Who knew? I'll tell you something. I've been lucky that way. My father-in-law's name is Alan. I've been very lucky because he's a good man, just a decent man, and he's always been there, and he's always there for questions, and he's a great grandfather to my kids. Talk about lucky, because I have friends that have father-in-laws and mother-in-laws, for that matter, that are not really easy to work with. And I'll tell you something, their lives are like twice as hard as my life. I've been very lucky that way, very blessed. But anyway, today I figured I'd do a check-in with the markets because we're really in a moment of truth kind of week in front of us here. And this week, especially today, tomorrow, and Friday, is probably going to set the tone for the rest of the year in terms of the economy and the market. Today we have the FOMC meeting, which is a very big deal. The president's been trying to put pressure on the Fed chairman to lower rates. But again, I certainly don't think a Fed chairman that's beholden to a president is a good idea. This is what gave us the inflation of the 70s when Arthur Burns was beholden and under pressure from Nixon all the time, and he just did what Nixon wanted. And it didn't matter. What would happen is if the Fed lowered rates prematurely, the last time the Fed did it in December, basically what happened is the only rate that really matters, the 10-year, which is what mortgages are based on, and a bunch of other things are based on, stock valuations, all these other things, that went higher. So I'm not sure that the president, look, the president said a lot of great things, but when it comes to interest rates, even lowering rates in the short term, this concept of fiscal dominance, really market participants are really going to say, no, not going to happen. It's really spiked rates for the 10-year, which is not a good idea. But anyway, today we have the FOMC meeting. Tomorrow, we have a lot of big tech earnings, Apple, Amazon, Microsoft, Meta. So that's a big idea. And the idea here is to get an idea of the resilience of the economy. And these companies are going to really talk about what AI spending looks like and how that trade is coming along. And look, overall, so far this earnings season, S&P companies have generally been beating forecasts, but those were already lowered. So the bar wasn't that high. But look, let's not forget the market's been going gangbusters, but profits on the S&P 500 are only up 4.5%. We're definitely in very high value territory here. But again, as I said the other day, stocks can stay overvalued for very long periods of time. The key is for you not to get high off your own supply by the nonsense that some of these things are worth it. Remember something, a lot of people don't really understand this. Company could be the best company in the world, but the question is, what is the stock worth? It's like a car. A Honda Accord could be the best car in the world. It can work for 200,000 miles, get you from point A to point B, always start, everything could be great all the way. But is it worth $1 million? Is it worth $500,000? No, the car is worth $20,000, $30,000, whatever it sells for these days. So again, it could be the best car in the world, the most reliable car in the world, but that doesn't tell you what the asset, what the car is actually worth. Same thing with stocks. You can have the best company in the world, but it doesn't really tell you what that business is worth. And a lot of the businesses that are trading, that are stocks that are publicly traded right now, are selling above what they're worth. Anyway, so profits are up 4.5%. Then we have Friday some indications on consumer spending. And what we've seen so far is that consumer spending remains pretty strong. But the bad news is a lot of the earnings that we've been seeing have been driven by wealthier customers. And look, most Americans really aren't wealthy. So that means most Americans, low-income customers, are having trouble. This inflation is really not doing well for them. And American Airlines, just to put a point on it, American Airlines Group said that their premium cabin demand has been doing great. Again, wealthier customers. Deckers Outdoor said their pricey shoes, their UGG, their sheepskin boots that everybody seems to want to wear these days, especially my daughter and her friends, those are doing really well. United Airlines and Delta said corporate travel was leading their rebound. So again, we're seeing that wealthy slice of Americans spending money. On the flip side, you look at Chipotle, which says that low-income customers are under pressure. And there's a few other companies that have said their low-income customers are under pressure. Also, Conagra said that. Abbott Labs said that. So, we're at that transition point in the market where you have a generally positive screen with danger signs here and there sprinkled. It's not like when we released Midnight in America last year where we didn't know who was going to be elected and that could have gone either way. This is a different scenario. We are definitely in a market that is high valued, but there are still some great pockets of opportunity still in the marketplace that we've been talking about a lot recently. One is with copper. The other one is with defense, especially European and American defense, drone makers, et cetera, et cetera. There's a bunch of them, and we talk about them. Biotech. Biotech actually might be the biggest, most undervalued opportunity in the markets today because that sector's just got hammered the past 6 months since the election, since RFK took over at HHS. Anyway, so this is a big week, and it's going to set the tone for a lot of the things that we talk about in the weeks ahead. Anyway, that's all I have for you today. Have a wonderful Wednesday, and I'll speak to you tomorrow.